Welcome back to Inside the Wall. In this episode, we will be analyzing Nike's Greater China strategy and performance, specifically reviewing the Q1 fiscal 2026 update. This analysis provides the necessary context for Nike's recent Q2 fiscal 2026 earnings call. Greater China remains a critical but increasingly problematic part of Nike's business. In fiscal 2025, the region generated about $6.5 billion in revenue, over 14% of Nike's global sales. But momentum has turned sharply negative. Revenue declined in the low to mid-teens in fiscal 25 and continued to fall around 10% year over year in the first quarter of fiscal 26. While China was once a major profit engine, it now represents a material drag on consolidated performance, forcing management to rethink its strategy in a region that still accounts for more than 12% of total revenue. Tracking management's tone reveals a clear shift in how Nike views Greater China. At the end of fiscal 2025, leadership framed the challenges as difficult but manageable, emphasizing patience and a long recovery without sounding alarmed. By the first quarter of fiscal 2026, that tone changed. Management warned China would be a headwind to both revenue and margins for the rest of the year, and began describing the issues as structural, not just cyclical. Most notably, they acknowledged the region could become an expensive operating model if sell-throughs don't improve, signaling rising concern about long-term profitability, not just near-term sales. Nike's China challenges are now showing up clearly in operations. Management has been aggressively resetting inventory, with Greater China units down double digits year over year, even as total company inventory rose. That signals a costly cleanup of higher-risk, aging product. This reset is directly hitting margins. Gross margin fell 320 basis points in Q1, driven by heavy discounting, with China specifically cited as still running an elevated closeout mix. At the same time, Nike is struggling in digital, describing China's online market as highly promotional and admitting it's still searching for the right model. Together, inventory pressure, margin erosion, and channel challenges define the reset underway in China. When you put the data, commentary, and operational signals together, Nike's posture in China becomes clear. This is not a short-term demand slowdown. Management has consistently said recovery will take time and described the market's challenges as structural, not cyclical. It's also not a market they've written off. Leadership continues to express long-term confidence in China's potential. Instead, the evidence points to a medium-term brand reset. Nike is clearing inventory, rethinking its digital strategy, and repositioning the brand through local products, sport-led storytelling, and refreshed stores. The risk is execution, because if sell-through doesn't improve, China becomes an expensive operating model. Nike's capital signals in China point to reinvestment, not retreat. Management is putting money into refreshing stores and elevating the marketplace, aiming to stabilize and reset the brand, rather than aggressively expand or pull back. But there's a disconnect in disclosures. Despite increasingly cautious commentary on earnings calls, Nike's formal risk factors haven't changed. The latest 10Q says there are no material updates from prior filings, which still list only broad, global risks. So while capital is being deployed to fix China, the specific risks there haven't yet been fully reflected in formal disclosures. Here's the bottom line on Nike's Greater China business. What we know is that the region is a real drag on results. Revenue fell nearly 13% in fiscal 2025 and declined again in early 2026. Management is intentionally clearing inventory, which is driving near-term margin pressure, and positioning this as a broader brand reset focused on sport, local products, and upgraded retail. What remains uncertain is timing. There's no clear turnaround timeline, the effectiveness of the strategy is unproven, and profitability in China's highly promotional digital channel is still unresolved. Importantly, filings don't yet quantify consumer sentiment or the investment required to fix the business. Thank you for watching Inside the Wall. Leave a comment for any questions.